Hello, everyone. Welcome back to Impactful Gems. Today, I have a special guest, Hiley Rainey.
Oh, wow, I'm special.
Yes, you are. You are. And I'm excited about having you on today. And we're going to talk about some things dealing with credit. And you are a credit and finance expert. And so I just want to interview you about some things that could help some people with with assistance about things that they may need some help working on. Okay.
Well,
So
I'm
that's
excited
good.
to be here. Thank you. And I appreciate you having me on your show.
Yes, you're welcome. I'm excited. I'm excited. So I want to start with just talking in general about if you can make just a general statement about, since you're a credit and finance expert, just you could just I would just like to know a general statement about the importance of credit and working on your credit and just in the finance arena, whatever you want to share about that initially.
Sure. Well, before I do that, if I could tell you just a little bit about myself. I mean, but maybe for your
Yeah,
audience.
sure.
Um,
Sure.
of course, my name is Hiley Rainey. I run a company called Credit Renovators, but more to the point, I've been in real estate and mortgage financing for longer than I want to say, since the '80s. And so I've seen just about everything when it comes to credit. I've worked with many folks who started out, you know, from the bottom to the top. Now they're here, as the song says. But I've worked for several banks in mortgage. I professionally am a mortgage underwriter, so I'm one of those folks who make decisions when people apply for a mortgage. So I pretty much know credit, and so here we go with um, now in this day and age with so many things going on, the importance of credit is as it always has been. I mean, when you talk about credit, credit is your financial, or at least your bill paying financial credit card, credit report, or, like your school report, where you say your credit report has your history of how you managed your accounts, how you handled your bill paying, how you manage your spending. So you're telling the world how you conduct your business. And
Mm-hmm.
so obviously, like any other report card, you want it to be a good report.
Right.
And so
Right.
the idea is, if you want people to trust you to borrow money in the future, in the present and the future, your best argument is what you've done in the past.
Right.
Now, people make mistakes, things happen, mismanagement. We all can learn from our mistakes. And so the process of credit restoration is that some things we can eliminate so that nobody ever needs to know it happened. Other things we can say, okay, we moved on past that, and we now demonstrate good habits with how we manage our credit. Because really, credit management, just like in finance, when I help people with their finances, whether people succeed or not is dependent largely on their habits, the way they conduct themselves, and that's largely dependent on their mindset. Because if you got the right mindset, you'll develop the right habits, and you will get the best outcomes that you can. So obviously, credit is your rating by which you have the ability to borrow money. So
Mm.
because we all know, no matter how much money you make, even if you made $150,000 a year and you say, I want a $150,000 house, it's going to take you some years to save up that, because you can't save your entire pay for the house,
Right.
that you still got to live in the meantime. So if you were a person who making $150,000 a year and you say, I want to buy a $200,000 house, if you had to save that money up, how many years could
Mm.
it take? Because 150 grand, probably after taxes, you probably take home 90. You still got other bills, you still got to live. How much of that can you really sock away towards your house? If you're
Right.
if you're really good, maybe 35, 40 grand, that $200,000 house is still going to take 5 years at that
Mm.
savings rate or investing rate to get you there. Well, if you have good credit to go along with that good income, now instead of taking 5 years to borrow to save up the money to buy a $200,000 house, you can borrow the money in 5 days or 5 weeks. The
Mm.
time it takes to close a loan. That's what I mean by 5 weeks. And so now with credit, you have the ability to leverage your income. And so now that house that would take you 5 years to save up and buy, you can
Mhm.
borrow now and enjoy the house now. So it enables you to have a better lifestyle. Some people say lifestyle is the big end all and be all. Other people say lifestyle is just another word for being fake. No, we're talking about a real lifestyle. We're not talking about
Mm.
using credit to pretend like you got more than you have.
Right.
That's one. And then obviously with the right mindset, you're going to have better outcomes because you're always going to be doing things in a way using your credit and your income together, leveraging one off the other to have the best outcomes that you could have. And when you're enjoying with the right mindset, you're living within your means. You won't have any credit stress. You won't have any income stress because you're living within your means. And then you still have the ability to drive a nicer car, live in a nicer house, which is nothing wrong with that, as long as
Right.
it's within your means, and then
Right.
still be able to have a sustainable, productive savings rate that can
Mm.
convert into investments so that you can start to talk about building some sort of wealth.
Mm. Okay. Okay. Thanks for that background, because I think it's so important for people to know how you came into. Now, I do have to ask you, um, what made you want to start your own business, as far as kind of dealing with the credit and the finance?
I think because I always joke with people and folks that know me, I always say I attribute a lot of my characteristics to having the farmer gene. By that, it starts with like I'm an early bird. I'm a person. I get up at 4 o'clock every morning. That's just
Mm.
natural for
Woo.
me. Um, but again, I don't stay up late either. I go to bed at 10:30, 10:30. Um,
Mhm.
it's not to say that I've never stayed up past that or I've always gotten up at 4, but it's natural for me. Most
Right.
people like the whole concept, people say sleep in on the weekends. That's not a concept for me. If anything, I'll go if it's a relation like vacation mode. I might still get up early, but I'll certainly go back to sleep, or
Mhm.
something like that. But
Your
the
body is
farmer,
wired for that.
yeah,
You're
yeah,
used to doing
I'm wired for that. But the
that.
farmer
Mhm.
gene, and I always talk about having the farmer brown gene in relation to that, but it goes much deeper than that because, as you know, farmers are some of the hardest working people in the world, and
Mhm.
they get up early, they go to work early, they're working all day, but the point is, farming is about, and a lot of people don't understand how much the farming concept and how it ties to nature and how nature ties to our abundance, our productivity. Because what is the one thing that we know that most farmers do, unless they're just dairy farmers, but they're sowing seeds.
The seed. Mhm.
And
Right.
so they're sowing seeds to plant
Mhm.
crops. And the expression, like people mistake the expression, they say you reap what you sow. No, in the natural world and in the farming world, you don't reap what you sow, you reap more than you
More.
sow. And so the
Mhm.
idea for us in our lives and in our finances, we want to reap so that we can, we want to sow and so that we can reap more than what we sow. When you put money into an investment account, you put $100 or $1,000 in investment account. You didn't put it in $1,000 to have $1,000 later. You put
Right.
in 1,000 so you can have $5,000 later. The
Right.
idea is for it to grow. Well, it starts even without talking about investing, just talking about the basic person. So me, I've always been interested in making money. I mean, as a kid, I did everything. I would mow lawns In the wintertime, I shovel snow to make
Mm,
money.
mm.
I had neighbors, like older neighbors, they wanted their garage cleaned out or they want their basement cleaned out. Any of that. I did summer jobs and, all of that. Um, and I've always been, like wired, I guess you could say, to like want to earn money, want to do that, want to do things for people and customer service, as it's called. Now, as a kid, I didn't think of it in those terms as customer service. It was like, okay, I'm doing this job, I'm getting paid for it. The person is happy with the job. They say, oh, you did a really good job. And as a kid, that, kids, we like attaboys. And then,
Right.
of course, and then you got paid on top of that. And then they liked your job so much that they went and told another neighbor, oh, yeah, he did a good job. So they say, okay, yeah, Mrs. Robinson said you did a good job on her garage. Come clean out mine. And so
Right.
having that, being sought after, being in demand, so to speak,
Mhm.
it's good for your pride. If you take pride in your work and you try to do the best job you can, that's just something that's always been for me. So, but and to wrap, how I ended up doing this as a business. I mean, of course, in the mortgage industry, we always go through ups and downs. When the rates go up and all that, and then it gets slow. Mortgage underwriters are typically some of the highest paid people on the operations salary side of a mortgage business. And
Mhm.
so when things get slow, they typically cut costs. They lay off people. And so, I've, had a few, not every single time, but I've had a few times where I was one of the folks got laid off when the market got slow and whatever. And so with this last layoff that I had, I decided because I had been doing this, helping people on the side. People always came to me when they had questions about credit and finance and things like that. And so I said, well, you know what? I've helped so many people. Let me see if I can monetize this. And then when
Mhm.
I discovered that credit repair, as the industry is known as, that people were doing that as a business, I said, oh, okay, well, let me. I do that already. I might as well, you know, make a living off of it. And so that brought me here to where I am now. It's been almost nearly 3 years since I started to monetize this as a business.
Wow. Wow. That's great. That's great. So, what better, I did want to ask, what better habits would you say people need to have success as far as credit and finance?
Oh, I mean, to be successful in credit and finance, number one, you got to live within your means. In other words, you got to live within your paycheck. So if you bring home $5,000 a month, you shouldn't be spending $5,000 a month. If
So,
you if you
should they live in their means or below their means?
I believe that you should live below your means unless within you count within your means, your savings rate and your ability to save and your ability to invest. So
Right.
all of those are within what I determine as means. I know some people look at the means part is what is my bills, and then after I pay my bills, I've done a good job. I paid all my bills, so now I can spend the rest of my money any way I want. That's
Mhm.
fine, but all you're
Mhm.
doing is contributing to conspicuous consumption. If you're not putting any money away, pay yourself first, as they like to call it, in many
Right.
personal finance folks, pay yourself by keeping money in the bank for
Mhm.
emergencies. And so having money saved up for emergencies, having credit capacity built up for emergencies, and then obviously as your savings grow, you want to convert that into investments. Not it doesn't have to be anything highfalutin. A simple um, mutual fund you want to save there. And that's assuming, I'm hoping out loud for you, your audience members out there that are employed and have a 401k saving
Mhm.
plan at their work and they're taking advantage of that. Because I know a great number of people who don't, because they think they can't live without the money that would go into their 401k, because they're
Mm.
not realizing that 401k funds, the money that's going in is pre-tax. So it's money they wouldn't have gotten anyway,
Mm.
at least not all of it. And so, but the idea is you want to have a good habit of living below your means. You want to have a good habit of having discipline with how you spend your money, discipline
Mm,
with how you pay your bills, because paying your bills is important, but your financial freedom requires more than just paying your bills.
for sure.
You have to build wealth. You have to accumulate
Mm,
assets. The best kind of
right.
asset is money. Is the kind that generates cash. But it's you just you want to have a habit of tracking your spending, because a lot of people nickel and dime themselves to death because they spend $40 here, $30 here, and before they know it, they've spent $300 in a weekend on.
They're like, what happened to the money?
And then they
What
say, "What happened
happened?
to my money?" You know, and
Right.
then they think the answer for them is they need more money. I happen to believe that it's more than just about making more money. It's about making your money faster. But that's more of an entrepreneurial track. So I'm not going to go down that, and just because
Mhm.
I don't want to go there with the people who are
Right.
just, they say, "Hey, I'm a salaried or hourly employee. That's my lane. I'm sticking with it." And so
Right.
how do I make the most out of the money that I earn in that regard? Again, living below your means, tracking your spending, and then and be disciplined with saving, even if it's a lot. And see, because some people think, "Oh, it's no point in saving $10 a week. That's nothing." That's a start, because 10 can turn into 20, which can turn into 100, which can turn into 1,000.
Right.
Once you get in the habit of spending, I'm gonna tell you, and I've helped many people, and they were not in the habit of saving,
Yeah.
and they started out small.
Yeah.
And when they're as they accumulated more and more money, and there was various things I had to do to incentivize them, to convince them, "Don't touch this money."
Right.
After a while, it becomes addictive, because when you see your balance grow, and then
Yeah.
obviously when the balance gets bigger, even with a simple savings account, you're getting some interest, not a lot, but obviously the amount of interest you get increases with the balance. And so when people start to see a balance accumulate, and then they start to worry less about what if, and you're not living paycheck to paycheck, it becomes
Hmm.
easier and easier to save, to the point where you start getting excited when you see that balance. And
Right.
then
For sure.
now I've had people who now they don't want to touch the money. They say, "Oh,
Right.
I want to touch," even when they had a good reason to. They said, "No, no, I don't want to mess it up. I got this money." And
Right.
you start to feel the weight lift off to you, because you got something other than just your next paycheck.
Yeah. I like that. That's good. That's good. What are some outcomes that people would have if they focus on repairing their credit? What are some outcomes that they would have?
Okay, that's a good
That they
question.
or that they could have?
Right. And they would, if they accomplished it. The could is definitely a would. But depending on where they are now, and I'm gonna talk in terms of scores, because
Mhm.
that's the measuring stick by most people relate things. Even though I want to press upon folks that when you talk about managing and improve your credit, you got to look beyond score, because the score
Mhm.
is actually the result of the things that you do in terms of what's on your credit report. So having said that, um, well, number one, depending on where you are right now, whether you're at the level where you're getting denials, no approvals at all, or if you're
Yeah.
somebody that's getting approvals, but they're the
Mhm.
bare minimum. And
Mhm.
so let's talk about the people who aren't getting any approvals at all. So if
Right.
your credit score is so low, or you got so many issues on your credit that no one will give you an approval, obviously cleaning all of that up. So in other words, if there's accounts on there that are collections, charge off, and things where a new lender go, "What's going on with this? Why you didn't pay those people? And if you didn't pay them, how do I know you're going to pay me?" So
Right.
that's the part that where you have items on your credit that are being that are influencing a live person who's making a decision. And then
Right.
you obviously have the other part where all of this negative data is affecting the algorithm that computes the score.
Oh, okay.
And that's why you end up with a 450, because the algorithm says all these negative items are whittling away from that potential 850 score at the top, the perfect
Right.
spreading score, and it's saying nope, 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 nope. And so by the time it
Right.
whittles all that down, 400 points are gone, and you're at 450 instead of
Wow.
850. So
Mm,
you got the algorithm hurting your score because it's taking into account all this negative information, and then you have a live person who looks at your credit and go, mm-mm,
right.
this person don't pay nobody. So
Right.
obviously, if you remove that information, if you're able to clean it up, pay what you need to pay, eliminate what doesn't supposed to be there, so on and so forth, the outcome there is you're going to have a better credit file to look at, so that
Right.
anybody making a credit decision on you are going to say, oh, okay, this is nice. Okay, they took care of this. They took care of that. Even if they saw old delinquencies, they say, oh, okay, this person obviously learned their lesson. They got better habits now. And so now
Right.
we can trust them to loan
Right.
to pay us back if we extend credit to them. And then, of
Right.
course, on the other side is with all that negative data eliminated, removed, changed, updated, the algorithm is not going to have that data there, and you're going to have a higher credit score,
Right.
the kind that will get you approvals. So if you, that's that. But if you're the person who's already getting approvals, but your credit score is still only minimum, is barely good enough to get approvals, well, what's going to happen there is, even though you're getting approvals, you're going to have, instead of an 8% car loan rate, you're going to have a 16.99. So
Right.
obviously, higher rate means higher payment, more
Right.
money it costs to borrow. So
For
by
sure.
having better credit, you can borrow at better rates. You can get more favorable terms. In other words, when your credit score is low, even if they give you an approval, like a car lot, they'll give you an approval pretty much if you got a heartbeat. But they're going to charge you 16.99% interest. They're going to want $3,000 down. And then they're going
Mm,
to tell you things like, well, you can only buy this 2008 bust out SUV instead of
yep.
a nice car. And this car right here
Right.
is going to be nothing but problem and troubles. It's going to sink you deeper, because you're going to be ended up spending all your money keeping this thing running.
The
So
repairs.
so the outcomes you will get, like I mentioned before, is better credit. You're going to be able to leverage whatever your income is, no matter what your level. Because I tell you what, somebody, a person with $75,000 income and bad credit can find themselves in a worse situation than somebody who makes $50,000 a year with good credit. That person with $50,000 and good credit, I bet you they can get more and better than the person with the $75,000 income and the poor credit, because they have good credit to leverage this income.
Right.
These have a higher income, but they have no good credit to leverage. So if I
Right.
leverage this and this, I can ultimately I can borrow. And again, we're not talking about a total abandonment and just consumer spending for the sake of spending, but we're talking about at least somebody trying to live a decent quality of life. That
Right.
person with the $50,000 income and the good credit, they can get the $200,000 house. Now, affordability, you have to look at the numbers. But even if they didn't go 200,000, they say, okay, I'll do 125. The person
Mm,
with the $50,000 income and the good credit, they can get the $125,000, $140,000 house easy. Have a interest rate that's much better than the person with the $75,000 income and the poor credit. If it's poor, if it's bad if it's so bad they can't get any financing, then obviously they can only rely on the cash. If
mm,
if the credit is just good enough to get approvals, they might be able to get a house, but now their rate is actually going to be higher than them. Even if they bought the same priced house, their costs are going to be higher. For instance, if I may, just speak in general, here's a hypothetical. You
mm,
got two people, right? They're both looking, say they want to buy a $160,000 house or a
mm,
$200,000 house. They know they got to do a down payment, so they're going to end up borrowing for the mortgage part 160 grand. So it's $200,000 house minus down payment and then plus closing costs. So say they both have to come up with a $160,000 loan for
mm,
their mortgage. The person with the better credit score say they're above 640, right? So they got a credit score 640 or higher. And with today's rates, I'm going to use a hypothetical, but because it's ballpark though, it is close. So based on today's rates, that person might have may say if they get a 6.5, they could get a 6.5% interest rate. Now, if you do the math, that $160,000 loan mortgage, 30-year rate term at 6.5% interest rate. Now, this is just the mortgage part. This is not taxes and insurance. That is $958 a month.
Okay.
Right?
Okay.
So that's the person. That's that. Now that same person with the $75,000 income, yet they got the worst credit score. Say their credit score is 600, bare minimum they need to get an approval. But they're not going to get a 6.5% rate. They're going to get, say, an 8.5, maybe 9. But let's just say, for the sake of argument, they were able to get an 8.5 without buying down the rate or anything like that. So 8.5, same $160,000 loan. That monthly payment will be $1,153.
That much more?
That much more. 2% in interest rate costs you that much more. So think about it for a minute. If you were somebody who was considering, buying a house, and then you say, well, my credit is good enough to get an approval. I don't think I really need to take the time and the energy to make my credit score better. Either I don't want to take the time to do it, or if I shopped around, I don't want to take the time and the effort to learn how to do it myself. And I say, I'm thinking about hiring someone who is a credit repair restoration expert like myself, and say, I don't know if I want to pay them. It ain't worth it, or it's too expensive, or something like that. So say I tell you, I'm taking the next 3 to 6 months to fix your credit. It's going to cost you about $750. $750. You say $750? That's a lot of money just to fix the credit. Well, let's think about it this way. Think about it. You pay $750 to clean up your credit, and you take the time to do it. So you say that's a lot of money. I don't have to spend that because I can get my credit right now. But if you're the person who's getting your mortgage at $850 and you're spending $205 or so more a month,
right,
to do that, think about it. That's $200 a month, every month more for the next 30 years. So instead of paying $750, get a better credit score now, you're going to pay $200 more your first mortgage payment. The next 12, you're going to pay $2,400. That's more than 3 times what you pay to have somebody help you fix your credit to get a better mortgage loan situation, right? So you're not spending more money. You're going to not save, but you're going to see a lower cost. It costs you more money to not fix your credit and end up with higher interest rates and higher payments. You pay out more money. So that is $2,460 for the first year at the higher rate, just in the payment alone for the same house, or at least the same loan. And then now you could do that over the next 30 years. That's $79,300 over the life of that loan that you pay more because you decided to do a big ticket, major financing decision with less than optimal credit. And then because you did that to save money on not paying somebody to help you fix it, you spend way more money. And see, that's what a lot of people don't understand when they don't want to hire expertise, because they say, oh, I'm not getting anything. You're saving tons of money. And so you got that part, but and for a lot of people, what I just described is very abstract. So it's hard for them to think about that. But to me, I said, there's nothing abstract about telling me I got to pay $200 more a month simply because my credit is this. If I make it this, I can save $200 a month, or I can pay $200 a month less. Not now, not tomorrow, but now, tomorrow, the next 12 months, the next 30 years, right?
Right.
And I'm gonna go
What
one step further. Oh, I'm sorry.
Go
Go
ahead.
ahead.
I was just going to ask really quick while we were talking about that. Is it, um, do you look at it like what you were just describing, that people, they don't want to they don't look at it as making an investment in themselves and their
Exactly.
future?
Yep.
Okay.
Yep,
Right.
exactly. And that's exactly what is an investment. And it's going to reap more than you sow, because guess
Right.
what? That $700 that in time and effort that you spent making your credit better is going to reap you not the $700 back, but
Right.
2,400 in the first year and more money every year after that. Hundreds
Right.
of thousands of dollars in interest, all because you didn't invest in yourself now here at this level,
Mm-hmm.
because you thought
Mm-hmm.
you were worried about this $750, which you're just going to spend anyway, and then you're going to see. In other words, you're giving up you're paying a long-term price for a
Mm-hmm.
short-term, what you perceive as a short-term gain.
Right.
What you want to do is have short-term losses that reap long-term gains. You reap more than you sow. You reap more than you sow, and that's the idea. So when people have that mindset, you will win. You live a better life. You're going to be better because you're spending less money on
Right.
things that when you don't have to.
Right. Right.
Um, yeah. And what I was going to say, and if you go you go a step further. Oh man, I forgot what I was going to say. Um, but anyway, but that's basically it. So just having that thought process and having that way of thinking, and when you're trying to decide and make decisions, a lot of people think about instant gratification, or they
Yeah.
feel they have the need for instant
Yeah.
gratification. They don't want to sacrifice this much today for
Right.
this much tomorrow, and sometimes even
Right.
more.
And
um
especially now we live in the microwave age. So, that
Right,
whole
instant, right.
mindset.
Microwave, drive-through. Nobody wants to wait for anything.
Right.
And I can tell you one universal truth that has not changed despite all of that is that anything that's worth having is going to require some time, some energy, and sometimes some money. But like,
Away.
because I talk to my clients and I talk about the word system. As as an acronym, not it's a system, but a system works as an acronym, and it says save yourself time, energy, and money. So when you have a
Mm-hmm.
good system, which that's what I have, good habits, you string together a bunch of good habits, you
Yeah.
create a system for yourself. And if it's
Right.
the good habits, you'll have a good system which will save you time, energy. You'll save yourself time, energy, and money.
Right. I
And
like.
people say time is money. No, time is not money. Time is infinitely more valuable than money. But
Mm-hmm.
if you can save both, that's great. Systems do
Right.
that. But typically, if you want to save time, you have to spend money. And
Right.
if you
That's
spend money, you spend money to save time. If you're
that's good.
spending money on anything that does not save you time, and then you take that time that you save to do something productive for yourself, that's
Right.
another form of investment.
That's
So
good.
investment is more than just money. It's how you invest in yourself.
For sure. For sure. That's good. So I wanted to move on to another subject, which is unfortunately, a lot of people go through this, or a lot of people have had this happen to them, or they are um, maybe possibly going to have this happen to them. And that is car repossession
Ah,
situations. So say, for example, somebody's having a problem paying their car note. Okay. What are the choices people have? Because some people, they don't know they have choices. Like they really don't. They just think, oh, the repo man, they gonna come take the car. But what are the choices people have if they are behind on their car note?
okay.
And then after you answer that, when you elaborate on that, if you could talk about, because I know this is like right under that, how should they go about whatever situations that they have? Like, what are the choices and how should they go about solving that situation?
Gotcha. Okay. Well, essentially, it comes down to why are you in repossession, and that's usually, if you're on, because it usually comes down to this. Most people are there. You're either unwilling to make the payment or you're unable to make the payment, or I should say it the other way around. You're unable to make the payment and you're unwilling to make the payments. And
Mm-hmm.
so, if that's the case, that you do have many options. Okay.
Mm.
So, if you're unable to make the payment, what's the reason why? Um, did your income reduce? Did it go down? Did you lose your income? And when I say
Job
reduce,
loss,
it could be
job
zero.
loss, maybe.
Yeah, job loss. It could be
Mm.
layoff or just furlough, or say your job you historically earned overtime and bonus, and now that's no longer available. You just have your straight base salary, and so you built a lifestyle. You built a um, a means of living level that was based on that bonus and overtime instead of living within your means at your base salary and having that. And so now you find yourself, when you made that decision to buy that vehicle, it was based on you earning overtime and bonus that you no longer have. That happens. And I don't fault people for that. I just think it's not a good idea. I know some jobs, overtime and bonus is inherently built in, and you don't really have that many circumstances where you lose it. Because like if you're a first responder, they work overtime and bonus because they work crazy hours, 3 days on, 3 days off, things like that. And so their unions have that negotiated in. But aside from that, so whatever reason, loss of income could be loss of spouse, divorce, death, any of those things, but a loss of income, or that's an inability to pay. If it's no longer willing to pay, that's because you had issues with the car, um, mechanical issues, and so you found yourself in budget crisis because you're faced with, you don't even have enough money to pay for repairs, and pay the note at the same time. And so then
Mm.
you make a decision. Some people say, well, I don't want to make the payment if the car is not running. I'm sitting up here paying for a car. This is the mindset. I'm paying for a car that doesn't run. No, you're paying a loan. You're paying for the loan that you took out to buy the car.
Right.
The condition of the car has nothing to do with your obligation on the loan. A lot of people don't like to hear that, and I get boos and hisses when I remind people of that, because I'm like, look, you borrowed money to buy a car. You didn't borrow
Right.
you borrowed money to buy a car. So you owe the
Mhm.
money regardless of what happens with the car. And so
Right.
but I get it. In a budget situation, you got to make a choice. You only have a limited amount of money, but you got
Right.
to get creative in getting the car fixed and still making the payment. And if
Right.
sometimes you got to go late and catch back up, then you understand that too. But you don't say, well, I can't make the payment because the car got to get fixed and I'm not paying for that. And you want to blame the lender, or you want to blame somebody else and say, well, I'm justifying me not making my obligation because of a situation that I didn't like. I get it.
Right.
You're a victim of circumstance, if nothing else,
For
even though I
sure.
don't like to use the word victim, but you still got to make the obligation that you signed up for in good faith when you took out that auto loan. There's nothing in the loan that's predicated upon the condition of the car.
Right.
That's your property that you have to maintain, whether you have a note or not. And so,
Mhm.
having said that, if someone is faced with an inability to pay, you got two choices. You can either contact the lender and ask
Mhm.
them to modify your loan, so maybe you have a temporary reduction of payment. So if your payment, say
Mhm.
your payment is $500 a month, and you got
Mhm.
3 years left on your loan, they may say, okay, tell you what we'll do. For 6 months, we'll reduce your payment from $500 to $300 for the next 6 months. The difference between what you would have paid, should have been paying, and what we're going to allow you to pay, we're going to throw that on your balance. And that might give you some breathing room to figure out another job, higher paying job, somehow replacing that income, or making some changes to the rest of your budget to make So when you got to go back to the $500 payment, it's now manageable again.
Well, I have a
Or
question.
yes,
I have a question about that because I've never heard of that. That what you just said about the
loan
reduction of the
modification.
payment.
Yeah,
No,
loan.
I've
It's
heard
called,
of. Is that different than putting it on the back end of the loan?
that is putting it
Like,
on the back end. The back end is the balance. That's an expression. When they say put it on the back end, they're saying they're putting it on the balance. So you're going to end up
oh,
owing more money. Instead of payments, you put it on the back end of the so-called pay schedule, but basically you're adding it to the balance.
so are you? So would you still be paying more money at the end? You know, like
Absolutely.
okay, that's
Absolutely.
what I thought. Okay,
Because
that's what I thought.
now what you're essentially doing is borrowing on the money you're borrowing.
Got it. Okay, got it. So I didn't want to interrupt
Remember,
you,
they're
but
not doing this as a charity. They're just trying to keep the loan viable because they don't want
got
to see you go delinquent any more than you do.
it.
So if they can do that, and they have a criteria by which they determine whether you're eligible for that. It's not a
Right,
foregone conclusion. There's an eligibility
right,
process at play. The second part is the other side of that coin is if you can't get the payment to go down, you got to come up with another way to earn more money.
right.
And I talk about things like side gigs, things like that to earn extra money. There's side gigs you can do like affiliate commissions and things of that nature. I know a lot of people don't really know about that, but it is a good way. Or just a plain old regular second job if you need
Right,
to do that. But
right,
I know that may not be feasible for some people.
right,
And then there's also things like rather than work at a job, maybe use that very car that you're struggling paying with it, put that joker to work. And either you go and you become an Uber driver. And I know that might
yeah,
not necessarily be appetizing to some people, appealing, I
right,
should say, but it is an option if you want to keep your car. If keeping your car means I got to spend a few hours every day during the week to make some extra money, you might as well
right,
use the car to pay for
right,
itself. That's one way to
right,
do it. That might be more appealing than going to work at a diner or something, becoming a waitress or some other side job where you're doing more physical labor. You're driving. So you say, I'm going to take the car and I'm going to use the car to make extra money doing Uber or Lyft or any of the other ones out there and
right.
use that extra money to pay my car note.
Got
That's
it.
one way. Or if you don't want to be a driver, you're uncomfortable with that, there's also car sharing services like Turo and Zipcar knows where you actually rent your car. So people
Mhm.
you sign up on the platform, they vet out the renters, and then you let people rent your car. So maybe while you're at work, you put your car active on Uber, Turo, and so people come and they rent the car while you're at work. They return the car, and then so by the time you get off of work, you might have had 2 or 3 people rent your car for a couple of hours, a few hours, 4 hours, maybe your whole shift. And then you're
Wow.
earning extra money, let somebody else do that. Now, again, I know that's not necessarily appealing to some people because they say, oh, I don't know if I want strangers driving my car. Well, guess
Right,
what?
right,
Hey, the repo man is a stranger, but when he
right,
take it, he ain't bringing
right,
it back.
right. He ain't bringing it back. Right,
You know,
right,
so
right.
if you got to make compromises, you got to be flexible.
For
But
sure,
again,
for
to
sure.
your question, these are options.
And I
Now, if
just
you're
wanted
on,
to say,
okay, go ahead. I was going to say
I'm
because
sorry.
I wanted to finish your question, answering your question.
Yes, I just wanted to say, so Impactful Gems, my channel, is also about most of the stuff that I talk about on my channel is stuff that I've been through or stuff, situations that I know that people have been through. But most of the stuff, I'm pretty much, this is like a very honest channel, a very transparent. So the questions that I'm asking you, some things I have not been through related to what you're talking about.
Mm-hmm.
But like for instance, when you were talking about like the back end, I had never heard of the reduction part. I had never heard of that. But years ago, I did have where it wasn't that the payment was reduced at all. The payment stayed the same,
Yeah,
but they put it they what they
you're
did
talking
was
about when you're say you had 3 months past due. That you're talking about when they take the past due amount, when
and
they're
put it
only
on the
taking the past due amount and putting that again, same thing. They're putting it on the balance, the so-called back end, but that just means they're just putting it back on the balance and you got to pay it later.
Right.
That's not a loan modification, or that's a loan modification only where they're not modifying the payment. They're just shifting the past due amount so you stop being late. But loan modification is where you're requesting that the modification of the payment as well as any past due amount. Because sometimes you don't have to wait until you're past due to ask for a loan modification. If you're being proactive, you know you got a loss of income. Don't wait 3 months and get past due, then ask for help. You ask for help early. So with a loan modification, you're asking for a reduction in payment so that you don't end up with a past due amount.
Right. And that's the other thing I wanted to talk about too regarding this is that, so for me, I was never the type of person that, you know how some people, I'm just going to use the word run from, I mean, it's not funny, but you know, they had the car, they had it at other people's houses.
They avoid the calls, they ignore the letters, they avoid the calls, and then they hide the car. Honestly thinking, and see, okay, I'm sorry, go ahead, but yeah.
I just want to say this real quick regarding that. First of all, like the bank I have my car with now, like I never run from stuff like that anyway, but they're very like, how can I say, if I communicate with them, it's a very nice, bank. I'm not going to mention them, but they are really like, they appreciate that. Like, they're like, what? Yes, thanks for calling. Like, and they work with you. That communication part is so important.
Yeah, because and this is one thing, and then I want to finish answering your question. And that's something I talk about with people when I try to explain to people how they need to look at their lenders as partners. They the same friends when you wanted the car and you standing there going, "Oh, my beautiful new car." They gave me a loan, and then so they lended you the money to buy that beautiful car that you were so in love with.
Right.
And they were your partners. They should be looked at as partners, because I always tell people when you're in your financing life, you want to develop friends and partners. And so some people don't do that. They'll take out a loan with whoever says they'll give them one. So they got a loan over here. The loan gets paid off, they forget about you. You go over here, then you borrow a loan some money over here with this lender. They don't, when you get done, they get their money back, they forget about you. What you want to do is start cultivating a relationship with one or two or three lenders who will borrow you money. They will give you money for a credit card. They will loan you money for a car. They will have you have a bank account with them. And then they may do your mortgage for you too. Or if you decide to open up a business, they'll do business lending. And you want to move yourself from just being a customer or a consumer to a client. A valued client. First of all, you might end up being a valued customer versus a client. Those are the ones who say, we love working with you. We're more than happy, under the right circumstances, to help you with any of your financing needs, no matter what. We value as a customer. We want to let you know that because we value as a customer, here's an offer for you that the general public doesn't get, that you don't see in the newspaper or the magazine or on TV. These are for our valued customers. And that's the path there, because you want to develop who better to have a relationship with the people who got the money. Right. So ducking and dodging your auto lender is not a good way to make friends that way. So to answer the last part of your question, remember I talked about the unwilling to pay. I mean, the unable to pay. Let's talk about the unwilling to pay, which kind of segues into what you were talking about, the ducking and dodging of the car. Well, sometimes people decide they can't pay because of some unforeseen instance. Sometimes the unforeseen instance is so catastrophic, they want to walk away. For example, major mechanical issues to the point where the car is not even drivable anymore. And then the really catastrophic ones for some people, engine dies, transmission dies, and those are big ticket items, or other things like car, for some mysterious reason, catch on fire. And I can tell you a lot of reasons for that people don't talk about. I'm not talking about the, friction fire. The friction fire that's when your checkbook and your payment book get too close together.
What?
That's an expression. It's a down south expression. It's called a friction fire. They say when your car burned up in friction fire because your checkbook and your payment book got too close together,
Okay.
and you get a
I never
mysterious
heard
fire.
that.
I'm not talking about those. I'm talking about like sometimes people do. They buy a car, and especially with the youngsters, sometimes they buy a car and then they get modifications done to the car. They get big speakers put in it. They get other stuff, and then they hire people that don't know what they're doing, and they start messing with the wiring. And then one day they drive in the car, and the car bursts into flames because the
Oh, wow.
electrical shorts and things from improper work being done.
Wow.
And so they say a car burned up. Now, oftentimes, in conjunction with that, these self-same people are not being fiscally responsible in other areas of their life. So let me give you a scenario. Guy driving, car starts smoking. Next thing you know, it's on fire. It gets burned up. Find out that he had a sound system put in the car took the factory system out, had a custom system put in there. They didn't put it in right, and the wires overheated. Car burned up.
It's a mess.
Right. Now, that same person was not keeping up with their stuff, and they missed some payments, and suddenly now, lo and behold, their insurance had lapsed 2 months ago. So, car burns up, they can't file an insurance claim because their insurance is lapsed. Yet they still have a balance on the car. So what do they say? They're not thinking about the fact that I owe this. They're not recognizing that I owe this money regardless of the car being burned up. I owe this money, and I have no other recourse because I didn't keep my insurance current, so I can't go to them if they pay off my car because I had damage to the car. And then they say, well, I'm not paying for a car I don't have no more, because they keep thinking because when they went to the dealer, they borrowed the money and bought the car at the same time in the same place. So they think these two transactions are one. They think that the car is tied to the loan and the loan is tied to the car. Is not tied to the car. So they think the loan, even though they did one transaction, they think the two things. Because for them, the only reason why they made the loan was to buy the car. So they think if the car's gone, the loan should go too, because there's no car anymore. But they don't understand. No, you borrowed money to buy something.
Right.
You borrowed money to buy something, and whether that something still exists, whether something is still in good working order, your obligation to the loan does not change. There's nothing in your lending language that says you don't have to pay this loan off if the car died. You don't have to pay the loan off if this car is destroyed. And so people decide they're not going to pay. And then those are the people that duck and dodge, or they call the lender and say, hey, car burned up, you can come get it. And think that by giving them back what's left of this car, that releases them from the debt. And then those are the people who end up with that on their credit, $14,000, $15,000 or whatever, outstanding balance, and they still record it as a repossession, even though it's a burned out shell or whatever, if that's the case, or rolled over or whatever. It goes 30, 60, 90 days when they stop paying, collection, then charge off, but they put it after the 90 days, they tag it as a repossession because it's related to an automobile.
Wait a minute. So you mean the lending people charge it as a repossession?
Yeah, it's still a repossession. It's still a car. It's still even if it's burned up,
got it.
Flipped over, smashed, whatever, hit a pole, it's still a car. And remember, the car, the connection to the car and the loan is that the car serves as collateral for the loan. So the loan says you borrow money to buy this car, so we're going to make this car the collateral for the loan. If you don't pay the loan, we're going to take the car back. Now, obviously, if they repossess your car and your car is in working order, top dollar, it gets sold. The chances are that it getting sold for more, equal to or more than what you owe is higher if it's a decent car and it doesn't suffer from like terrible depreciation or anything like that. But if you got a car that's severely damaged, the value is basically little or nothing. Even if they take that car back and they know, well, now it's a burned out shell, it's only worth $1,000 or whatever, and you owe 15, guess what? You're gonna owe the 15 plus the repossession fee, the late fees when you went 30, 60, 90. then what's left of it either gets sold at auction, or if it's really a burned out husk, it's just going to get scrapped, and they're going to get $500 for it.
You went right into my next question about that. So the auction piece. So you kind of just explained it, but okay, say, because that's another option, right? They could just say let it go to, or like they could let it go. Is
Voluntary
that how it works?
repossession. Yeah, voluntary repossession.
Right.
Now, a voluntary repossession probably doesn't hold much water when it's a burned out shell of a car. But
No, I'm
normally,
talking about not a burnt out, but I'm talking about like you were talking about like a newer car or whatever.
right, a car that wasn't compromised in any way, but the person
Right.
just decided, I don't want this car anymore. Well,
Mhm.
let's go into that. First of all, if you decide you're going to voluntarily surrender your car through
Yeah.
repossession, the first thing you got to do is you got to call them. You have to call the
Right.
lender and say,
Right.
hey, I can't make the payments anymore. Before I get behind, I want to voluntarily surrender the car,
Mhm.
and do that. And so there depends on the lender and the company. They all have different process, their own process for how they want that to be done. So they will instruct you on what they want you to do to properly
Mhm.
surrender the car. Some of them say bring it to our reclamation yard. Some may take it to this place or take it to here, there. Some of them may not even say take it at all. They say just leave the car at home. We're going to send somebody to come get it. And
Got it.
so you follow their process for surrendering the car, because the idea here is that they agree to take the car back. They agree to sell the car. And whether they agree to try to get the best price or not, that's totally up to them. And then
Mhm.
you agree, when you do this voluntary surrender, you agree to pay the difference between whatever
Yeah.
the car sold for when they
Mhm.
ultimately sell it off, and what
Yeah.
you owe as the outstanding balance.
That
And
was
you
that was
owe,
the question that I
yep,
was saying. Do they still owe? They would have to pay the difference. So
yes,
say
they
the
would have to
car was
pay the difference. If the car sells for more than what they owe, they would get the difference in a check. If they
got it.
if it's less, if the car sells for less than what they owe, they have to pay the difference.
Pay the difference.
Yeah, which
Got
they would have
it.
to do whether they agree to or not. But the point is, by doing it this way, you don't, because if you don't do it this way, under the terms of your lending agreement, they can't even
Mhm.
touch the car for 90 days, because that's to protect you in your contract. If you get behind your payments, they have to give you time to catch up if you wanted to. So,
Got
but
it.
conversely, they can't take the car earlier than that either, even if you wanted them to. By the only way to negate that is by doing the voluntary repossession, because what that
Got
does is you sign a new piece of paper that says my loan contract is voided subject to the terms of this surrender. And so
got
there's
it.
a new set of rules that replaced your protections on the loan agreement. So now they don't have to wait 90 days to do something with the car. You're surrendering the car now. You're waiving your right to that 90 days to catch up on
Oh,
your
got
payments.
it.
You're waiving that so for them to take the car now. And if they
Got
take
it.
it now, they don't have to report you 30, 60, 90 days late, because they're taking the car now. And
Oh, okay.
then and then what they will do is you surrender the car gets processed, it gets sold, whether through retail or whether through auction or whatever. If the
Right.
car doesn't sell for more, equal to or more than what you owe the difference. And then, but here's the rub, you got to pay that difference in a timely manner, or now you're delinquent on that.
Oh, wait.
So that's,
Geesh.
you're still responsible. You still got to pay
Woo.
the toll. So the idea is, if you think you can, if you want to protect yourself, you can sell the car yourself like you normally would. You
Right.
sell the
Right. Right.
car
Right. Right.
yourself if you think you want to guarantee you get a price that's
Right.
close to what's owed. Now
Got
that's
it.
provided if you know that really know how much the car is worth and you're being realistic about that. But
Right.
that's the idea there is, and that's to protect your credit, and it's protecting your money too, because a voluntary surrender will usually save you on a lot of those fees that you will incur if you let the loan go delinquent, then let them come get it, then hope it gets sold. Because if you in that voluntary surrender, you may not have to pay a repossession fee. Like the repo man come to your house, get the car.
Right.
You surrender the car, they won't charge you that because you taking it to where they want. They didn't have to pay somebody to come get it out your driveway. So you
Right.
can save money there. You avoid the 30, 60, 90 late fees because you won't have that if you do a proper voluntary surrender. They won't charge you late fees because your contract is being voided before you become late. So you avoid those fees, and you save your credit because you avoid having 30, 60, 90s on your credit. Instead of, it'll just show as a voluntary surrender. And guess what? Usually if you do a voluntary surrender, and then you pay them their money, they won't even report it as a voluntary surrender. They'll just report it as loan closed. So the world would know you paid it off, but you have to do it the right way with them in advance.
And you have to take those steps.
Yeah, because people can avoid a lot of negative remarks and negative information on their credit if they manage and handle the situations proactively up front. Then there's nothing, they won't have to pay anybody to clean it up later if they just take the time, don't duck and dodge, talk to your lender, try to work something out, do whatever you need to do. There's usually a lot of options there, but it starts there.
That communication is so important. I'm telling you, I know from experience. We may have to do a part 2 on this repossession stuff. But I did want to, so that was that. So wrapping up this wonderful interview, I've learned so much myself. I'm like so grateful. So yeah, we may have to do a part 2 on some of this stuff.
Sure.
What would be in conclusion, what are some suggestions you have for realistic expectations when someone is thinking about working on their credit? What would be some realistic expectations for the person?
Well, you definitely got to have patience, regardless of whether you're working on your credit yourself and your finances for that matter, and whether you hire somebody to help you, or, a lot of people think they're hiring people to do it for them, but you hire somebody, they're not doing all the work. You still got to do work on your credit. They're going to help you. They're going to help work on certain things, and whether you're doing it yourself or whether you're hiring somebody to do it, there is a process, and it's not fast, and you have to have patience and let the process work. I know there's things you can do to make little micro jumps to your score in 30 days or less, but those are the superficial things that you want to do anyway. But if you got a lot of stuff on your credit, stuff that has to be resolved, that takes time. And so you have to have the patience for that. That's for sure. And have realistic expectations about the time it takes to get those things done.
So that expectation piece, that's also where people think, because I know a lot of people think this, that it's like you just said, and it's not a quick process. You have to go through, even if you have to take, your credit report and go line by line and say, okay, I need to call this person. I need to, especially the ones that's open. I'm not talking about the closed,
right?
The ones that's open. You may have to go line by line and say, okay, this, I need to call this lender. I need to call, this person and take care of it that way. That's good. That's
because
good.
on your active accounts, the first thing you got to do before you do anything else, you need to be current and up to date with your payments, because no matter how much bad negative credit items from your past that you got and you clean up and get off, that's important. It's good. But if you're trying to make your score go up, your score is never going to go up substantially as long as you're not handling your current active accounts responsibly. If you're late on your car payment, because with an installment loan like a car loan or a personal loan, you only got one job.
Right.
Make the payment and pay it on time. So I guess that could be 2 jobs. But really, all you got to do with installment loan is make the payment, then the amount that you agreed to and they said you pay on the date. Right. If there's a problem with you paying on that date because maybe that loan is bumping with your car loan or your rent or something, then you contact the lender. You say, hey, can we move this loan payment due date later in the month because it's running into my other big bill?
Right.
But you call and you say that, and that's so you have that installment loan. Now with credit cards, you got another job. You got to pay. You're expected to pay on time, and
Right.
then you got to manage the balance too, because you want to worry about things like credit utilization and
Right.
manage that, because you don't want to be maxed out on your cards, because they know statistically people who are maxed out have a higher chance of going into default. Once they can't
Right.
charge anymore, that it usually ends up in default, because some people stop paying their credit card when they can't charge anymore because they mad because their credit limit is stopped. Well, you got to pay what you owe first before you can get more
Right.
money, you know.
Right. Right.
So,
That makes sense.
so that's that.
That makes sense. So I wanted to wrap up this
Okay,
wonderful
well, wait a minute.
interview.
There's one other thing too,
What's
because
that?
although you asked me about the expectations, there's
Uh-huh.
another piece that goes with that. Because
What's that?
in connection with having realistic expectations and having the patience that you go with, you have to
Uh-huh.
know too that when you're fixing your credit, part of
Uh-huh.
that process is you have to go back and forth. Sometimes you're going back and forth with your lenders or collection agencies, things like that. So in that process, you got to be persistent. You have to have a level of persistence, because it's like, I got an issue
Well,
with
where
this
my
car.
tennis? Look at my look like this. You hit the
Boom.
ball back and forth.
Exactly. That's very emblematic of that, because it's a back and forth. So you got this thing on your credit, and you reach out to the creditor. You say, "Hey, I don't think this is right. Can you send me proof that this? Because I don't my balance wasn't this." And then you wait for them to send you the paperwork that says, "See, this is where we came out with our number." Once you get that paperwork, you got to look at it, and then you either say, "Yeah, it looks right to me," or "No, this ain't right because I don't remember this." And then you got
Right.
to go back to them and say, "Hey, I saw something on y'all paperwork. Now we got to talk about this specific thing because I don't remember this." And then they got to go
Right.
back and prove that one thing in detail. So there's back and forth. And whether you doing your credit yourself or hiring somebody, that process is
Mhm.
the same. And so there's a
Right.
lot of back and forth that goes on that a lot of people don't understand, but they think that every time they do something for their credit, they say, "I did this," and they think it's going to be an instant bump to their score because that's what the folks on the internet say. So you got to be
Right.
persistent in that process, in the process, and that's
Yeah.
where patience and persistence together, and then you'll get
Right.
results.
I like that. Oh, I learned
That's
a
all
lot. And I'm sure my viewers learned a lot too. So what do you want to leave what is the name of your business? And so that people who would like assistance, if they want to reach out or whatever else you want to end with,
Okay.
it's up
Well,
to you.
the name of my company is Credit Renovators LLC. Make
Okay.
sure when you search for me, you get the LLC, because there is another company out there that started using my name without the LLC, using my company name. And so I just want to make sure you don't confuse them. If you don't see my face on the page, it ain't me. That ain't me. So
Okay.
there's a company out there that's doing some DIY. They're basically doing a subscription service or something with DIY credit repair. They don't help people with their credit at all. They
Okay.
just they just give you a place you can sign up to help yourself, something. But
Okay.
anyway, make sure Credit Renovators LLC. You'll see my name. You'll see my face on there.
Okay.
You can reach me if you go to my website. You can go ahead and click on help me with my credit, and then you can fill in the form, and then I'll reach out to you. And then I generally do a credit audit where we look at your credit, and I tell you what your issues are, and offer you some solutions on how to get help with those things. Even some, if you want to work on your credit yourself, I have options for you to do that, because I know a lot of people are price sensitive, or they got budget issues where they can't afford to pay anybody, but they want to do it themselves, but they want a guide map on how to
Right.
do it themselves in the most
Right.
helpful way possible.
Right.
Yeah.
Well, I'm gonna put the link to your whatever website you have or
Hmm.
in the description.
Okay.
So I want to wrap up the interview. Thank you so much. And we're gonna get this credit together.
My pleasure, Laura. Thank you for having me on your show.
Thank you
And
for coming.
folks can also go to my YouTube channel as well, for
Okay.
more if they want more information on the credit issues, credit help with credit issues, as well as some other success things, because a lot of these things are universal. And so the same mindset you want to have for success in life, you definitely got to have with success when working on something like your credit or your finance.
So in the description box I'm also going to put your YouTube channel so that, if they wanted to, go
Oh,
there.
great. Okay, that'd be great.
Okay.
Thank you.
All
Okay,
right. Thank you so much.
thank you, and you take care. Bye, guys.
Bye. Bye-bye.